Hey everyone, welcome back to Crypto Tax Australia. Today's video is one I've been wanting to make for a while, because there's a massive difference between avoiding tax, which is illegal, and minimizing tax, which is not only legal, but something the ATO actively expects you to do. Every single strategy I'm covering today is straight from the ATO's own rules. No loopholes, no gray areas, no, I heard this from someone on Reddit. Just legitimate, documented strategies that everyday Aussie crypto investors are either using or leaving on the table. And that last part is what gets me. Most people I talk to are overpaying their crypto tax simply because they don't know these strategies exist, not because they're doing anything wrong, just because nobody told them. So today I'm fixing that. I'm going to walk you through the most practical, accessible tax reduction strategies available to Australian crypto investors in 2026, and I'll tell you exactly what the ATO says about each one. Let's get into it. Let's start with the most powerful and most underused strategy available to crypto investors in Australia, the 50% CGT discount. Here's how it works. If you hold a crypto asset for more than 12 months before disposing of it, selling, swapping, gifting, whatever, you only pay tax on half your capital gain. The other half is completely tax-free. Let me show you the numbers. Say you bought $5,000 worth of Bitcoin, and it's now worth $15,000. Your capital gain is $10,000. If you sell before 12 months, that full $10,000 gets added to your taxable income for the year. If you wait until after 12 months, only $5,000 gets added to your taxable income. The other $5,000 is gone, legally. Now, how much tax that actually saves you depends on your marginal rate. Under the current 2025-26 brackets, most everyday Aussie investors earning between $45,001 and $135,000 sit in the 30% bracket. And when you add the 2% Medicare levy, that's an effective rate of 32%. At 32%, having a $10,000 gain saves you $2,600 in actual tax, just by waiting. And if your income puts you in the next bracket, $135,001 to $190,000, you're at 37% plus Medicare, so 39% effective. Having that same gain saves you $1,250. The higher your income, the more powerful this discount becomes. The ATO is clear on this. The discount applies to individuals and complying superannuation funds. It does not apply if you're classified as a crypto trader running a business, which is a different tax treatment entirely. The practical takeaway: before you sell or swap anything, check the acquisition date. If you're 10 months in, waiting 8 more weeks could literally save you thousands of dollars. Strategy number 2 is something every investor with a mixed portfolio should understand: capital loss harvesting. Here's the principle. Capital losses can be used to offset capital gains in the same financial year. So if you've made gains on some assets and losses on others, you can strategically dispose of your losing positions to bring your net taxable gain down. Example, you made an $8,000 gain on Ethereum this year, but you're also sitting on a $3,000 unrealized loss on a token that hasn't recovered. If you sell that token before June 30th, your net taxable gain drops from $8,000 to $5,000. At the 32% effective rate most Australians face, that's $960 saved. And at the 39% bracket, it's over $1,270. And here's the part most people miss. If your losses exceed your gains in a given year, you can carry those losses forward indefinitely. They don't expire. They sit there waiting to offset future gains, potentially for years. A few important rules to know. You can't offset losses against ordinary income. Capital losses only offset capital gains, not your salary, not your business income. This is a common misconception. Wash sale rules. The ATO has been increasingly vocal about wash sales, which is where you sell an asset at a loss and immediately rebuy it just to crystallize the loss for tax purposes while keeping your position. The ATO can treat this as a scheme to avoid tax and disallow the loss. If you're going to harvest a loss, be genuine about it. Don't sell and rebuy the same asset within a few days purely for tax purposes. The order matters. When you're calculating gains, you can choose which parcels of an asset you're selling, whether that's the ones you bought most recently, the cheapest ones, or the most expensive. This is called parcel selection, and it can meaningfully affect your tax outcome. A good crypto tax tool or accountant will help you optimize this. Strategy 3 is simple but powerful. Timing. The Australian financial year ends on June 30th. That date is your best friend as a crypto investor if you use it deliberately. Here's what smart timing looks like in practice. Defer gains into the next financial year. If you're planning to sell a position that will generate a significant gain and June 30 is approaching, consider whether you can wait until July 1. Your gain will be assessed in the next financial year instead, which gives you an extra 12 months before that tax bill is due, and may land in a year where your total income is lower, dropping you into a cheaper tax bracket. Bring forward losses into the current financial year. Opposite strategy. If you have losing positions you were planning to exit anyway, doing it before June 30th means those losses can offset gains you've already made this year. Wait until July 1st, and those losses carry into next year instead, which may be less useful. Check your 12-month anniversary. As we covered in Strategy 1, if an asset is approaching its 12-month acquisition date, waiting until after that date before selling could have your tax on the gain. If June 30th is coming up and your 12-month date is in August, seriously consider waiting. Income fluctuations matter too. Capital gains get stacked on top of your total taxable income for the year. Under the 20-25-26 brackets, the jump from the 30% rate to the 37% rate kicks in at $135,001. If realizing a large gain this year would push you over that threshold, deferring to a lower income year could shift that gain into the cheaper bracket, saving you 7 cents on every dollar above the threshold, plus the Medicare levy difference. None of this is tax avoidance. Timing your transactions around the financial year is straightforward, legal tax planning that any accountant would recommend. This one is less commonly talked about but worth knowing, the personal use asset exemption. The ATO says that if you acquire crypto solely for personal use or consumption, meaning you buy it specifically to purchase goods or services, and you use it quickly for that purpose, it may be exempt from CGT. The key conditions are strict. The crypto must be acquired for personal use, not as an investment. It must be used within a short time frame. The longer you hold it before spending, the weaker the argument. The cost of the crypto must be $10,000 or less. So practically speaking, if you loaded up a small amount of crypto specifically to buy something online and spent it within days, that transaction may fall under this exemption. What this is not, it's not a backdoor to avoid tax on your investment portfolio by claiming you always intended to spend it. The ATO looks at the facts. If you bought $50,000 of Bitcoin, held it for 2 years, and then spent some of it, that's an investment disposal, not personal use. The ATO is clear that the intention at the time of acquisition is what matters. This is a narrow exemption, but for small everyday crypto spending, it's a legitimate one that not enough people know about. Strategy 5 isn't glamorous, but it might be the one that saves you the most money. Simply making sure your cost base is calculated correctly. Your cost base is what you originally paid for an asset. Your capital gain is proceeds minus cost base. So, the higher your cost base, the lower your gain. Here's what legitimately belongs in your cost base that people regularly miss: transaction fees. Every fee you paid to acquire crypto, exchange fees, brokerage fees, gas fees, can be added to your cost base. On a high volume of transactions, this adds up significantly and directly reduces your taxable gains. Incidental costs. Costs directly related to acquiring or disposing of the asset, including certain professional fees, may also be included. Getting your acquisition price right. If you acquired crypto through an airdrop, a hard fork, mining, or staking, the cost base rules are different for each. Getting these wrong, particularly by understating your cost base, means you'll pay more CGT than you legally owe. This is another area where crypto tax software earns its money. Coinly and similar tools automatically include fees and cost-based calculations across thousands of transactions, something that's genuinely error-prone to do manually. If you've been calculating your gains without including fees, it's worth going back and checking. You may have been overpaying. Okay, let's talk about the audit question, because it's right there in the title of this video, and you deserve a straight answer. The ATO has been increasingly active in the crypto space. They receive data directly from Australian exchanges under the data matching program, which means they can see whether you've been trading and cross-reference it against your tax return. If you've been active on Coinbase, Binance, SwiftX, CoinSpot, or any other exchange operating in Australia, there's a reasonable chance the ATO already has some visibility over your activity. What flags a review or audit? Not declaring at all. This is the biggest one. If the ATO's data matching shows exchange activity and your tax return shows nothing, that's a red flag. Inconsistent reporting. If your declared gains don't match what the exchange data suggests, expect questions. Wash sales. As mentioned earlier, selling and immediately rebuying to manufacture losses is something the ATO has specifically called out. Unusually large deductions without supporting records. What keeps you clear? Report everything, even losses. Declaring losses actually demonstrates you're engaging properly with the system. Keep records for at least 5 years. Date, amount, AUD value, platform, fees. For every transaction, use compliant tools. A Coinly report or similar gives you a defensible, documented paper trail. Lodge on time. Late lodgement draws attention. If you're behind, voluntary disclosure is always better than waiting to be caught. The strategies in this video are all legitimate and documented in ATO guidance. Using them doesn't make you a target. It makes you a compliant investor who understands the rules. So let's bring it all together. 5 strategies, all legal, all documented by the ATO. 1. Hold for 12 months to access the 50% CGT discount. 2. Harvest capital losses to offset your gains before June 30th. 3. Time your disposals around the financial year end deliberately. 4. Understand the personal use exemption for small crypto spending. 5. Get your cost base right and include every fee you're entitled to. None of these require a complicated structure or a high-priced accountant to access. They just require you to know they exist. And now you do. If you want to see how I pull all of this together practically, including tracking cost bases and identifying the 12-month discount automatically, check out my Coinly walkthrough video linked on screen. The affiliate link is in the description if you want to try it free. Drop a comment below with which strategy was most useful for you, or if there's one you're already using that I didn't cover. Subscribe if you haven't already, like the video if it helped, and I'll see you in the next one.